Want to see someone systematically disprove everything you have read about trading stocks and expose how and why you will consistently lose money if you aren't doing it right? Click the link in the description to check it out for yourself. But now for today's video.
The question, how do I successfully pick stocks? Answer by Money Hike. Hi, all you have to do is look around you. Great stocks are all around us. Whenever you go out to shop at your favorite mall or dine at your favorite food places, you are surrounded by numerous stocks. Look at the stores around you and think about what they are. Ask yourself who makes the products that you bought today. After you know the names of these companies, check if they are publicly traded companies. If they are, you can buy them at the National Stock Exchange, NSE, or Bombay Stock Exchange, BSE. How should you start? I'm sure you research a little before buying any product. You check for different vendors, see where you can get the product for the lowest price, read reviews to check what other people are saying about it. This is the same type of research you need to do when picking stocks for your portfolio. If you spend as little as 1 to 3 hours on stock research in a week, you can easily find great stocks that can potentially become a 5-bagger or 10-baggers or more over the years. Have a look at Kotak Mahindra Bank's stock movement. Source: Value Research. Back in January 2005, the stock price was around 25 rupees. The stock climbed to over 320 rupees in January 2008. After that, the stock fell due to the worldwide financial crisis. The stock declined all throughout 2008 until March of 2009. From then on, it began a steady climb up. In July 2017, the stock reached 1,000 rupees. If you bought the stock back in January 2005 for 25 rupees and are still holding it until July 2017 during, your investment has reaped a whopping 3,900% profit. Yes, you read that right. If you had bought 1,000 shares at 25 rupees, i.e., a total initial investment of 25,000 rupees back in 2005. At present, your investment value would have been 1 million rupees. Just a small amount of 25,000 rupees would be turned into 10 rupees lakhs in a span of 12 years. Believe in yourself, you have what it takes to beat the market. Most of you are thinking, I don't understand stocks, or how the stock market works. And many of you must be thinking, I'm not a finance person, I can't do this. Well, that's completely wrong. Each and every one of us has the potential to find stocks that can go up 50%, 100%, 150%, or 200%, or even more. We just need to follow some guidelines and keep our eyes and ears open. Some habits that will help you find good stocks are reading. Whether you read the newspapers, books, finance magazines, or articles on the internet, it will always help you find the best stocks in the market. Reading will always keep you up to date on the latest happenings in your country as well as the world. Listening, yes, you can just keep your ears open and find a potential stock that can double or triple your wealth. Listening to other people talk about various new products and stores in the market can help you find good stocks. If you hear about a new product from someone who says it is one of the best in the market, find the company that makes it and see if it is a publicly traded company. Read about the product and see how it has improved sales for the company. If you feel that the product is going to be a success and fundamentals of the company are in check, you can definitely invest in this company's stock. Watching TV. You must be wondering, how can watching TV help me in finding great stocks? Well, look at the advertisements on TV. If you're a sports fan, look at the companies who sponsor athletes and teams. These are some of the ways that can help you find potential stock winners: 50%, 100% plus returns. For example, Sachin Tendulkar's bat always had an MRF logo. Today, MRF is trading at over 65,000 rupees. The internet. In this day and age, the one thing that can help you find the best stocks anytime, anywhere is the internet. Even social media can help you find great stock picks if you just be vigilant and sincere enough to read the right articles. Some broad guidelines on how to pick good stocks in Indian market. Look for stocks with a track record of growing earnings. Always look for a company which has growing earnings record. If the company's earnings are growing, it means that it is on the right track. Company should have products and that have increasing demand for several years to come. If a company has products whose demand will increase in future, this will lead to increased sales. Increasing sales is a good sign for the company. Research and development of new products is taken seriously. It is very important for companies to research and develop new products that improve the existing products. This is because customers' requirements keep changing, technology keeps changing, and all companies need to devote time and effort in research and development. Otherwise, new companies will take over the market share. Increasing profit margin is a good sign. Look for companies that have increasing profit margins. If sales are increasing but costs have gone up tremendously, the profits will not flow in. The company needs to make processes efficient and the management needs to work on increasing profit margins always. Management should be able and strong. The management of the company should be focused on increasing stockholders' value and not their own bank accounts. If you find a company whose management is vested into finding new ways to increase business, looking for different growth opportunities, working on improving current operations, researching and developing new products, you are lucky and have found a gem of a company. Low debt is good. Make sure you check how the debt the company has. If the debt is too high, the company may not be able to sustain its operations and may end up going bankrupt. Financial ratio analysis. Perform ratio analysis to see the profitability and liquidity condition of the company. These 7 points are just broad guidelines that you can use to pick good stocks in the Indian market. Answer by Samir Garwal. An investor should not invest solely on market tips since they can be biased and recommended stocks may not appropriate for you. Investors should do some research on the company and its business environment before investing. A proper research can save you from making bad investments. Here are some of the things that an investor should do before investing in the company. Know the company. The first thing an investor should do is to go through the history of the company. The history of a company tells the journey of the company and its accomplishments. History narrates what path company chose for growth, whether it did acquisitions for growth or invested in its own business to grow. Next, an investor should read is the philosophy, mission and vision of the company. These things help to understand the focus of the company. Once an investor goes through the company profile, he will have understanding of the company business. Understand the business. An investor should understand the business model of the company after going through the profile of the company. He should know the products and services it is providing. He should understand the revenue drivers and the raw materials which it is using. In addition, he should investigate whether the company is making profit or losses and why. In addition, an investor should find out what are the competitive advantages of the company over its competitors. Some of the competitive edges are a strong brand, low-cost model, sophisticated technology, patents, copyrights, entry barriers, etc. Management integrity. Management integrity is the foremost important thing that organizations should have. Unethical managements have shrunk the organizations. It does not matter how much the business is good if the management is unethical and indulged in scandals or illegal activities. 1. Should not invest in a company if its management is unethical. Financial performance. Financial performance of a company is also an important aspect of analyzing. If the company is making profits, an investor should analyze whether revenue growth, profits and profit margins are sustainable or not. In a loss-making company, an investor should investigate whether the company will turn profitable in foreseeable future or not. A company with consistent financial performance is preferable over a company having a volatile financial history. Risk factors. An investor should know the various risks of a company. For example, banks are sensitive to RBI policy rates. If RBI cuts the interest rate, banks' stocks rise suddenly. Pharma companies' stock are sensitive to the decision of drug regulators. Power producing and transmission companies' stock are sensitive to government regulators. In addition, companies are also exposed to currency risk and political risk. An investor should find out what are the factors that can affect the company business. You should not invest in the stock market on another person's calls without understanding the valuation of the company. The higher price does not make a company expensive while lower does not make a company cheap. There are a number of valuation techniques which determines whether a stock is expensive or cheap. Here are some of them. Earnings per share, EPS. Earnings per share tell how much profit is earned per share. It is calculated by dividing profit after tax with the total number of outstanding shares. For a company having a total outstanding share of 10 crores, which made a profit after tax of 1,000 crore rupees, the EPS is 10 rupees. Generally, it is good to have high EPS companies with consistent growth rate. In long run, these companies outperform companies with volatile EPS. However, only EPS cannot give the clear picture of the company since it does not consider the shareholders' funds of the company. Two companies can have the same EPS. A company generating the same EPS using less shareholders' funds is preferable. Price to earnings, PE, ratio. Price to earnings ratio indicates that how much investors are ready to pay per rupee of earnings. It is calculated by dividing the share price by EPS. If the company has an EPS of 10 rupees and the market price of a stock is 200 rupees, the P ratio of the stock 20. This signifies that investors are ready to pay 20 rupees per rupee of earnings. PE ratio is widely used for relative valuation. Assuming other factors remaining same, a low P stock is preferable over high P. Price to book value, PB, ratio. Price to book value ratio tells us how much investors are ready to pay for per rupee of book value. It is calculated by dividing the market price of the stock with book value per share. A company having book value per share of 40 rupees and the market price of a stock is 200 rupees, PB ratio is 5. Typically, PB ratio should be used in commodity companies and banks. A lower PBV stock is preferable. Dividend payout ratio. Dividend payout ratio tells us how much profit a company is sharing with shareholders and how much it has retained. The dividend payout ratio is calculated by dividing DPS with EPS or dividend payout with profit after tax. Generally, mature companies have high dividend payout ratio since they do not have new projects to invest. Whereas, the companies which are in growth phase invest more so they pay less dividend. Dividend yield. Dividend yield tells us how much dividend a company is paying relative to its market price. In other words, dividend yield signifies how much investors are getting for each rupee invested in equity. If a company paid a dividend of 20 rupees per share and its shares are trading at 150 rupees per share, the dividend yield is 13.33%. Generally, a company with higher dividend yield is preferred since high dividend yield means investors will get more cash in comparison to low dividend yield company. Return on equity, ROE. Return on equity tells how much a company making returns on shareholder funds. It is calculated by dividing profit after tax with the total shareholders' equity. If the profit after tax of a company stood at 20 crore rupees and the shareholders' funds is 100 crore rupees, the ROE is 20%. A company with higher ROE is preferred since higher ROE means the company is efficient in using equity capital. Generally, companies with higher ROE are preferable. An investor should not invest solely on market tips since they can be biased and recommended stocks may not appropriate for you. Investors should do some research on the company and its business environment before investing. A proper research can save you from making bad investments. Here are some of the things that an investor should do before investing in the company. Know the company. The first thing an investor should do is to go through the history of the company. The history of a company tells the journey of the company and its accomplishments. History narrates what path company chose for growth, whether it did acquisitions for growth or invested in its own business to grow. Next, an investor should read is the philosophy, mission and vision of the company. These things help to understand the focus of the company. Once an investor goes through the company profile, he will have understanding of the company business. Understand the business. An investor should understand the business model of the company after going through the profile of the company. He should know the products and services it is providing. He should understand the revenue drivers and the raw materials which it is using. In addition, he should investigate whether the company is making profit or losses and why. In addition, an investor should find out what are the competitive advantages of the company over its competitors. Some of the competitive edges are a strong brand, low-cost model, sophisticated technology, patents, copyrights, entry barriers, etc. Management integrity. Management integrity is the foremost important thing that organizations should have. Unethical managements have shrunk the organizations. It does not matter how much the business is good if the management is unethical and indulged in scandals or illegal activities. 1. Should not invest in a company if its management is unethical. Financial performance. Financial performance of a company is also an important aspect of analyzing. If the company is making profits, an investor should analyze whether revenue growth, profits and profit margins are sustainable or not. In a loss-making company, an investor should investigate whether the company will turn profitable in foreseeable future or not. A company with consistent financial performance is preferable over a company having a volatile financial history. Risk factors. An investor should know the various risks accompanying. For example, banks are sensitive to RBI policy rates. If RBI cuts the interest rate, bank stocks rise suddenly. Pharma companies' stock are sensitive to the decision of drug regulators. Power producing and transmission companies' stock are sensitive to government regulators. In addition, companies are also exposed to currency risk and political risk. An investor should find out what are the factors that can affect the company business. Conclusion: an investor should properly investigate the company before investing in it. A thorough analysis can make more money while reducing risk. Besides, in short-term markets are quite volatile, thus investors should invest for long-term. Answer by Kim Iskian. This question is right up there with what is love? Does God exist? And why does toast always fall butter side down? In the pantheon of the great unanswerables of life. However, that doesn't stop people and me from trying to answer. There are lots and lots of possible ways to address this. For our purposes here, I'm going to suggest that for the biggest gains, exploit the holy trinity of growth investing. 1. Find a growing sector. 2. Identify the leading company in this sector, and 3. Buy the leading company when it's cheap. When it comes to stocks, buying the best at the right price is worth it. There are a lot of ways to make and lose money as an investor. Some strategies are very complex. Others are common sense and simple to understand, but not always easy to implement. As a rule of thumb, if you invest in the best company in a dying industry, you'll probably lose money. You're fighting the tide and will probably wind up out at sea. And if you invest in an average company in a growing sector, things could go either way. Of course, valuations matter here as well. Here are 2 examples to show how the Holy Trinity works. Apple blossoms. Apple shares, NASDAQ, ticker, Apple, were trading for $18 in the spring of 2009. And it just so happens that Apple met all 3 of the investment trifecta at that time. 1. Top sector. Smartphone use was on the verge of exploding. 2. Leading company. There was no product like the iPhone, not to mention Apple's other products. 3. Cheap valuation. Despite its growth rate and outlook, Apple stock carried a price to earnings (PE) multiple nearly the same as the S&P 500. In other words, it was valued the same as an average stock on the S&P 500, even though it was a leading company in a high-growth sector. If you'd bought Apple shares in the spring of 2009 when it met the 3 growth criteria, you would have made nearly 400% over the next 3 years, compared to the return of the S&P 500 of about 50%. And if you held onto the shares until today, you'd be up over 500%. Of course, if only is not a valid investment strategy, as in, if only I bought Apple share when they were just $18. We all have perfect hindsight, and if these decisions were always obvious and easy, we'd all be rich. We know now that smartphone usage was about to blow up in 2009. Did we know that then? Well, I'm sure some people did. 100 degrees at Baidu. Another example of exploiting these 3 growth factors is Chinese search engine giant Baidu, NASDAQ, ticker, Baidu. It's like the Google of China, and the name in Chinese literally means 100, Bei, degrees, do. In early 2013, Baidu was already China's top search engine. Shares were trading for $90 each. Even then, Baidu still met the 3 top growth criteria. 1. Top sector. Internet search had been growing steadily for years and forecasts called for more of the same. 2. Leading company. Baidu had long before overtaken Google in China, the world's fastest growing economy at the time. 3. Cheap valuation. Baidu stock's PE, price to earnings, ratio had pulled back to 20, a small premium to the market, despite its long growth history and positive outlook. Over the next year and a half, Baidu shares moved up nearly 200%. At the time, Apple and Baidu were not undiscovered gems. They were already giant, successful companies. While it appeared that their success would continue, at the time their stories felt stale to many investors, some of whom no doubt felt the need to try to discover new emerging companies to earn a big return. But ignoring the well-run market leaders trading at a reasonable valuation was a mistake. This easy-to-understand strategy: identify a leading sector, find the leading company in the sector, buy when the stock valuations are cheap, isn't so easy to execute. Is a high-growth sector slowing down? Has the leading company in the sector lost its way with a misguided strategy or management mistakes? Is the apparently attractive valuation accurately pricing in a slowdown in growth? And of course, we all have perfect hindsight. These opportunities are obvious now, but may not have been at the time. Photo courtesy. But the strategy does work. You just need to watch for growing sectors, and buy the leading company in the sector when its stock price isn't too expensive. I write about Asia, energy, investing, personal finance, and how they all connect here. You can sign up for my free daily e-letter, The True Wealth Asian Investment Daily, on the website or by clicking here.